Hey everybody, this is Matthew Jackson with Solid Wealth Advisors, and today I'm going to be talking about the importance of understanding the beta inside your investment portfolio. Why is it important for you to understand what beta is? It's important for you to understand what beta is because you want to know the amount of risk that you're taking inside of your investment portfolio in order to get the returns that you're getting. And I can't give you an exact percentage of how many people don't understand what beta is, but I'll tell you from experience from doing this for years and years that most people that come through our doors that need help with retirement planning have no idea what the word beta means. So what does it mean? Beta is just a simple word that our industry substitutes in replacement of the word risk. And let me give you a quick example. We do comparisons of model portfolios all the time in our office. And we recently completed a model portfolio comparison with what somebody was currently doing as opposed to one of our model portfolios. And when we got finished doing the comparison, the couple came into the office and we looked at the report, and at first glance, things were exactly equal, meaning the returns that they were receiving were exactly equal to what we were offering. And I could see it in their eye when they saw those numbers, they were just about ready to say thank you and walk out the door and continue to do what they were doing. But before they could, I asked them a very simple question. And the question was, Mr. and Mrs. Jones, do you understand the amount of risk that you're taking inside your current investment portfolio as opposed to the amount of risk that you could be taking with our investment portfolio? And they had no idea. So we flipped the page and we looked at beta, or the measurement of risk. Now, when we looked at their model portfolio, and I'm going to give you the definition here in just a second, we saw very clearly that their current model portfolio, not only was it out of line with what their risk tolerance was, but it was much higher than what we were able to offer for the same exact return. So let me ask you a really simple question. All things being equal with returns, if you were able to get a 10% return taking on a high amount of risk, as opposed to getting a 10% return with taking a low amount of risk, which would you prefer? Yeah, just about everybody that I work with would say, I'd rather take less risk to get the same return. And that's why it's really important that you understand how much beta you have inside your investment portfolio. So how do you find it? There's many ways to find it, and here's where you won't find it. You won't find it on your brokerage statement, and you won't find it in your quarterly report. You can find what beta would be, or the aggregated beta of your investment portfolio, through a Morningstar report, or if you have individual holdings, Morningstar also does reports of what individual securities beta numbers are. I like Morningstar because they said they're independent and they're third party, but they do provide reporting on all the securities that are offered to investors that are out there. So where does it hit you in the pocketbook? Okay. If we had a beta of 1.0, then you would know that you're taking on the same amount of risk in that security with the benchmark that it's compared against. So if the underlying benchmark went up by 10%, then you know that security it's being compared against should also go up 10%. On the flip side, the more important thing that most people want me to help them understand is what would happen on the downside. Well, if we had a beta of 1.0, and the benchmark lost 10%, then we could assume that that underlying security might also lose 10%. So if you're the person that is risk averse, you want to be looking for a beta less than 1.0. So if you found a security that had a beta of 0.75, then you would know inherently that that particular security is 25% safer than the benchmark that it's being compared against. So dollars and cents, really quickly, here's the punchline. Pay attention. If you had $1 million portfolio and a security that you're looking at, or your portfolio aggregated had a beta of 1.0, and that benchmark lost 10%, you would assume that you might lose $100,000. That's pretty bad. But if you had a beta of 0.75, you might lose $75,000 if the market or that benchmark retracted by 10%, okay? Thereby keeping $25,000 more in your pocket. And that's, in my mind, the key to accumulating wealth. We want to follow one of the most important principles in investing, which is to get the highest amount of return for the lowest amount of risk. Not only is it important what you make, but more importantly, it's what you keep. There you go. There you have it. That's the definition of why it's important to understand the beta inside your investment portfolio. And remember, we help people achieve their retirement dreams through our gifts as retirement financial dream makers, using and adhering to our values of love, authenticity, and fairness. And the reason why we do what we do is because we want to see good, hardworking people just like you have the most fulfillment of happiness, health, and wellness in their retirement. Make sure you go live life true to yourself and follow your passions. And if you like this video, hit subscribe and we'll send you more free videos that will help you become a better educated investor. Have a fantastic day.